So, what's the one number, the single metric that can tell you the value of a skyscraper, unlock a multi-million-dollar loan, and literally make or break a real estate fortune? Nope, it's not some secret code or a stock price. It's called net operating income, or NOI. And today, we're going to dive deep into why it's the absolute bedrock of the entire real estate industry.
I mean, think about it for a second. How do you actually figure out the price of a massive office tower? You can't just go online and look up a Zestimate, right? So how in the world do the pros put a price tag on a building that brings in millions of dollars in rent? Well, they use a very specific tool. And honestly, it's simpler than you might think.
And the answer, the master key to this whole puzzle, is net operating income, NOI. The best way to think about it is like this. The NOI is the property's annual salary. It is the pure, unadulterated profit that the building itself generates every year, before you account for mortgages or the owner's personal taxes. It's the truest measure of the asset's raw earning power. Okay, so to really understand its power, we've got to pop the hood and take a look inside. Let's deconstruct how this annual salary is actually calculated. It's a pretty simple formula, but it holds the key to, well, everything. It really boils down to a simple two-step logic. First, you add up all the money the property could make. That's all the rent, parking fees, laundry money, you name it. And then you subtract a little bit for any empty units. That gives you what's called the effective gross income. Then you just subtract all the money it costs to run the place. And what's left over? That's your NOI. It's really just the money in minus the money out.
Now here's the secret sauce. It's actually what's excluded from the calculation that's so important. Look at that list on the right. Things like mortgage payments, big capital improvements, the owner's personal taxes, they're all left out on purpose. And why is that? Because it purifies the number. It lets you judge the building's performance completely on its own, which allows for a true apples-to-apples comparison with any other property out there.
All right, so we get the formula, but why is this one number king? Let's get to the important part, how NOI is actually used in the real world to create real, dollars and cents value.
You know, pretty much every major player in the commercial real estate world uses NOI for three absolutely critical things. First, they use it to figure out what a property is actually worth, that's its valuation. Second, lenders use it to decide if they're even going to give you a loan. And third, investors use it to figure out their potential returns. It's central to everything.
So let's make this real. Let's run a quick example. Imagine we're looking at a building, and after we do all the math, we figure out its net operating income. Its annual salary is exactly $500,000. Okay, so what's it worth? Well, to turn that income stream into a price tag, we use something called the capitalization rate, or cap rate for short. You can think of the cap rate as the market's pulse. It's basically the expected rate of return for a property like this in this specific area. So let's just say for our example, the market cap rate is 6%.
And boom, this is where the magic happens. You take that $500,000 of NOI, you divide it by that 6% cap rate, and you get an estimated property value of over $8.3 million. You see, the NOI directly dictates the building's price tag. It's a direct link.
Okay, now let's put on a banker's hat for a second. A lender looks at that same NOI and asks a different question. Can this property comfortably pay its mortgage? They calculate something called the debt service coverage ratio. A ratio of 1.25, for example, means the property is generating 25% more cash than it needs for its loan payment. That extra 25%, that's the safety cushion the bank needs to see to feel good about giving you the loan.
Right, so here's where it gets really interesting for investors. If NOI is the engine that drives value, then the smartest investors don't just calculate it, they actively work to make it bigger. This is literally the investor's playbook for creating wealth in real estate.
And they basically got two big levers they can pull to make this happen. On one side, you have the revenue levers. You can raise rents, fill up those empty units, maybe add new income streams like paid storage or new laundry machines. And on the other side, you have the expense levers. You can cut costs by, say, installing LED lighting to save on electricity or negotiating better deals with your vendors. Every single move is laser-focused on one thing, boosting that final NOI number.
Now this is where the really smart money is made. The most sophisticated investors don't just improve properties they already own, they hunt for properties where this work hasn't been done yet. They're looking for the gap between a property's current performance and its future potential.
So you have to think of every property as having two different NOIs.
First, there's the in-place NOI. That's what the property is making right now, today, with its current maybe below-market rents. But then there's the pro forma NOI. That's a projection of what the property could be making after you make some smart improvements and manage it better.
And that gap, that space between what the property is making and what it could be making, that, my friends, is everything. That is the value-add opportunity. A sharp investor buys a property based on its lower in-place NOI, knowing full well they can force it up to that higher pro forma NOI. That's how they literally create value out of thin air.
And here it is, the punchline to this whole thing. Because of that cap rate multiplier we talked about, every single dollar you add to the annual NOI doesn't just add $1 of value. Depending on the market, it can add $10, $15, or even $20 or more to the property's total worth. It is an incredible force multiplier for wealth creation.
So I'll leave you with this question. Think about a property you know really well, the apartment building you live in, maybe the office you work in. Now that you have this new lens, what's one small change, one lever you could pull on either the income or the expense side that could unlock the most value? Once you start asking that question, you will never, ever look at a building the same way again.